Okay, hi everyone. Thanks for taking off time from your precious Friday to join us on this option investing webinar. This will be the first of many series where we actually cover the basics of option investing. My name is Kevin. I'm an investment analyst with uSMART Securities. And just before I begin this presentation, I want to share with you a little quick disclaimer that this webinar is purely for educational purpose. The examples or any of this material does not constitute as financial advice, and past performance is usually not an indicator of future performance. And so I just want to start by sharing a little bit about myself and what is my background. So I work as an investment analyst in uSMART. Personally, I cover the US, Hong Kong, and Singapore equities market. I'm also an active trader in the US option market. And beyond options, we also do structured product recommendation for our high net worth clients. And this is generally a very quick rundown of what we're going to talk about today. So today's course will really be a options course for beginners. So we will first talk about what exactly are options, and then thereafter we will talk about what are the benefits of having options in your portfolio, and why every serious investor should actually consider using options as one of their tools to enhance their portfolio returns. Today we will cover more on core options, and we will take the perspective of both the buyer and the seller. We also share with you some case studies on how you can actually execute the trade using very practical methods. Lastly, I would like to actually share with you how you can get started on your option journey as easily as possible. So just a very quick introduction to options. What exactly is option, right? So option, it sounds like a very big word, but in essence, options is what we call a financial derivative. And what it sounds like a heavy word, but what it really means is that, it is just an instrument whose value is actually dependent on any specific underlying. So for example, if you're talking about stock options, your underlying could be a stock like Apple, or if you're looking at a broader market, like the S&P 500, you can have that as your underlying. You can even have options for commodities and even on interest rates. I'll go in more depth later and I'll use some examples so that it is a bit easier for yourself. But before that, I would like to share with you what exactly is the benefit of option and why should you care about options. Because unlike stocks or bonds or any other securities, the benefit of having options is that it gives you the opportunity to really profit in any market environment. So with the use of options, you can actually profit in a bullish market, a bearish market, as well as a sideways market. And in addition to that, options give you the opportunity to really generate extra income through the option selling strategies, which we will actually cover in more depth later. And lastly, for people who are actually interested in doing some form of speculation on market direction, option gives you the opportunity to make outsized gains with low capital requirement. So this is one of those financial instruments that you can actually make huge gains if you are right about it. And in the next few slides, I will share a little bit more on this. I'm actually trying to share with you, some of the option daily trade ideas that we generate on our platform, just to share with you what are some of the potential returns you could potentially generate if you are savvy with options. So just sit back and relax. So on our platform, we do have the daily trade option ideas under the intelligence tab. So you can click on our daily option picks. And right here, we have some of our options ideas that we've published on the past few days. And if you look at it, we actually have trades that could go as much as as much as 80 percentage point return. And some of it are as high as 40, 47 to 63%. And these returns are over a period of 1 week. So this is exactly what I mean when you can actually make outsized gain using very little capital. This is just an example of what you could potentially, derive from option. And now I would actually like to go a little bit more into the into what options are, and I will go in. So I will actually share from the perspective of the buyer and the seller. So a call option in this case is actually a financial derivative that provides the buyer the right to buy shares at a predetermined price at a specific date in the future. And usually option contracts come in a form of 100 shares. So if you are a call option buyer, you will actually have the right to buy 100 shares of any specific company at a certain price in the future. And if you are the call option seller, you actually have the obligation to sell shares at a predetermined price at a specific date in the future. And similar to the call option buyer, this contract are standardized, and usually it is at 100 share per counter. Okay, now this may sound very heavy or it may sound very technical. So I will try to use some simple analogy to basically use real life context to help you simplify it. So first, maybe let's start from understanding, what is the perspective from a call option buyer. Okay, so as we talk about, call option buyer is really about having the right to buy a share at a specific price sometime in the future. And the best analogy that I can think about is property investment, right? Because when you do property investment, assuming that you want to buy a condominium that costs you 1.5 million in Singapore, and to lock in the price, the unit at 1.5 million, you would usually have to make a down payment. And in Singapore context, we have it called the OTP, option to purchase. And let's assume, your down payment is 300,000, right? So you have to put a 300,000 down payment to lock in your unit at 1.5 million. And subsequently, assuming that the price of condominium appreciate beyond 1.5 million, you are likely to make a profit on this transaction. So option trading is actually no different, because a call option essentially is similar to placing a down payment. But instead of underlying being a property, now your underlying is actually a share. So when you actually buy a call option, you are in a way placing a down payment to earn the right to buy a stock at a certain price in the future. So as the share price appreciate, the value of your call option will appreciate as well. So buyers of call option are generally very optimistic on a particular stock or the market that they are looking at. So to bring it into the stock market example, right, I would like to use Apple as an example. So at the time of preparation for this presentation, Apple was actually at $180. And you can see that Apple share has been, steadily going up over the years, right? So let's take the example that you like to purchase Apple share at $180 on 30th June. And at the time of preparing this presentation, Apple options for 180 strike price is trading at $4.75. Now, it may sound complicated, but actually what we are saying here is that, if you buy this call option, you are paying $4.75 as a down payment to lock in this opportunity to buy Apple share at $180 on 30th of June. So if Apple appreciate beyond $180, it is quite likely that you will make a profit. Okay. And, with that, I would actually like to share with you some potential examples of what will happen to your profitability if Apple share price fluctuates within a certain range, right? So this is what we call a payoff diagram in option. And let's assume that, you would like to basically buy Apple at $180 strike price with a $5 premium. Okay, so what happens so let's go through the few scenarios that could possibly happen in an option trading scenario, right? What happens in scenario 1, which is if Apple share falls to $175 on 30th of June, what will happen, right? What will happen is that your option will expire worthless and you will lose the full premium amount. The reason is because your option has value because it gives you the right to buy Apple share at $180, right? But if Apple share is trading at $175 in the market right now, you would, as a investor that is interested to buy Apple shares, you will be much better off to buy Apple in the market at $175 instead of exercising the option to buy it at $180. And this is also the reason why Apple option in this case will actually expire worthless if Apple fall below $180. So the second scenario is what happens if Apple shares stay flat at $180. So if Apple shares stay flat at $180, your option will also expire worthless. And the reason is because while the option gives you the right to basically buy Apple shares at $180, you will be able to actually buy it from the market at $180. So there is no specific advantage to exercising your option to basically buy the share. Your option will actually have an intrinsic value of $0, and as a result, the investor will lose the full option premium. And the third possible scenario is, what if Apple share rose moderately to $182, right? Now we go back to the basics. And the basics is really the fact that a call option gives you the right to buy Apple share at $180, right? Now Apple share is actually $182. So one of the things you could do as an investor is basically exercise your call option to buy Apple share at $180 and sell it at the market at $182. And because of this possible profitability, your option has an intrinsic value of $2. And given the fact that you actually pay $5 per option, you will actually have a net loss of $3 per share. Okay. And the last scenario is the most favorable scenario, which is what is the value of your option if Apple share rose to $190? Now, because you have the right to buy Apple share at $180, you could exercise your option, buy it at $180, and you sell to the market at $190. So you will actually make a gain of $10, or in other words, your option also has a intrinsic value of $10. And given the fact that you paid $5 for the option, you will actually come up with a net gain of $5. Now, if I were to basically summarize everything I tried to talk about right here, basically buying a call option would give you unlimited upside potential. But in any case, in the worst case scenario, what is going to happen to you if you are wrong is that you are going to lose the option premium. And to basically break even from this trade, you actually, the share price will actually need to rise above your strike price and your option price. So if anything, if there's one thing that I hope you take away from this example is really the fact that, we have the potential for upside, unlimited upside, and there is a limited downside in terms of just your option premium. Okay, and now I would like to basically sorry, I saw a hand being raised on the participant. If you have any question, will you mind dropping it in the Q&A? Yeah, so that maybe I can see what's the question you have. Yeah. Okay. Maybe I will just maybe if you have any question, just feel free to drop in the Q&A. I will actually cover it at a later part. Okay. So now maybe I'll just share a little bit on the perspective of the call option seller first. Now, call option seller basically has the obligation to sell their stock at a specific price in the future. Now, unfortunately for this one, I was not able to think of an analogy that I could make it as simple. I couldn't exactly think of an accurate analogy without distorting the meaning. So I will actually take the angle of trying to use a very practical way to basically explain to you how what is the benefit and how does call option selling works. So call option selling is basically very beneficial to you as an investor in a sideways or moderately bullish market. So an investor, you just imagine an investor holding a basket of stocks for long-term investment, right? When you hold a basket of stock, the stock could move sideways for a very long period of time. So it could go up and then go down, go up and go down, go up and go down again, right? But so if the stock is moving sideways, usually you are not making any profit, and that can be extremely frustrating. Just like the chart here, the stock could be trending up and then it move within the range for a very long period of time, and nobody knows how long this range bound market can last. But what selling call option can provide you is, during this range bound market, you can actually generate additional income while waiting for the share price to move higher. So if you were to incorporate option selling of call option to your long-term investment, when the market is actually sideways, you can do much better than an investor that just buy and hold. So this is extremely beneficial in a sideways trending market. And I actually want to share a few examples of real life case where how you can actually take advantage of this. So a very good example that I have right here is Coca-Cola shares. So we all know that Coca-Cola is an extremely good consumer staple company. But so you can see from the trend that, longer term, it actually trend upwards. But even for a good consumer goods company, there can be a period of time where the share price go nowhere. So you look at the chart right here, in around 2020, for a very long period of time between the end of the start of 2022 all the way to 2023 this year, Coca-Cola share has been trading within these few boundaries, somewhere between $59 to around $64. So it has been going up, going down, going up, going down, going up, going down, and it has difficulty breaking past this $64 price level. Now, if you are a buy and hold investor during this period, assuming you enter the trade somewhere here, for that next few months, if you are buy and hold, you would actually end up with very little return during the year. But what if I tell you that you could potentially own Coca-Cola share during this period, and during these few months of sideways market, you can actually generate option income. during this period, a consistent stream of option income for the next few months, right? So this is one benefit of basically selling call option, because you can basically sell a call option at this $64 price level, and assuming that it doesn't go above $64, you'll get to keep your Coca-Cola shares and all the option income that you generate during this period. And I will show you an example later on the different possible scenarios that can happen. So I would like to introduce to you one of the option strategy. We call it the covered call strategy. So covered call strategy essentially is a mix of two things. Firstly, you have to own the underlying share, which is Coca-Cola, and then you sell a call option on Coca-Cola. And to simplify it, what it means when you do something like this, it means that you own assuming you own 100 shares of Coca-Cola, and then you sell you sell call option on Coca-Cola at $65. What it means is that at the end of the option expiry date, which is 30th June, you are actually obliged to sell your Coca-Cola share at $65 per share. Okay, so there may be different things that could happen during this 1 month period. So one of the things that could happen, which is the first scenario, that what if you buy Coca-Cola share, you sell a call option, and Coca-Cola share actually fell to $60. So what would happen? Now, assuming that you are a long-term investor, you would typically still hold on to Coca-Cola share, right? And assume that the option premium here is actually $3. So what's gonna happen is that you own Coca-Cola share, but at the same time, you will get to collect an option premium of $3 per share, okay? Which actually represent almost a 5 percentage point yield for that 1 month. So if Coca-Cola share actually move downwards, if you are a long-term investor, you will have, assuming you buy at $65, Coca-Cola share fell from 65 to 60, you will have lost $5, right? But if you buy Coca-Cola share at 65, you sell a call option at 65, you will have lost $5 on your capital gains, but you will be offset by the $3 of option premium that you actually earn. And and your option premium that you collect can also help to reduce your average cost, because having bought at $65, you will have the $3 premium income to basically reduce your break-even point to just $62. Now, what happens if we have a second scenario where Coca-Cola share actually stay flat at $65 after you sell the call? So what's going to happen is that your Coca-Cola share may get caught away at $65, meaning to say that you would sell Coca-Cola shares away at $65, but for doing that, you will still get to collect a premium of $3 per share, which is still not too bad, because basically you'll be getting close to a 5% return in a 1 month period. And the last scenario is, what happens if Coca-Cola share rise to $70? Now remember, we go back to the basics. What happens when we sell a call option? We are actually having the obligation to sell the asset at a certain price in the future, right? So in this case, our call option would actually give us the obligation to sell Coca-Cola share at $65. So even though Coca-Cola rise above $70, we are forced to sell Coca-Cola share at $65 because we want to earn that option premium, right? So in a way, you are giving up your future upside beyond $65, but you are being rewarded with the consistent option income of $3. So if there's one thing that I hope that you take away from this, is that when you sell a covered call or when you sell option, you are actually, what you are saying is that you are giving up your future, future upside in return for a predictable option income. and hopefully that the option income that you generate is good enough. It is going to be is going to be better than holding the shares, and that's why cover call usually works better in a sideways market. Because if let's say you are extremely bullish on a stock, assuming Tesla is extremely volatile, it can rise very quickly, and cover call will mean that you'll be giving up too much upside potential, and you may be better off just holding on to the stock. So with that, I would actually like to share with you some case studies, or rather some real examples of how we analyze and how we enter into an option trade. And hopefully that will give you some flavor of it. But don't worry if it's if you find it overwhelming. It's actually option trading is actually it's something that it takes a bit of time to basically get into. But what we can do on our end is basically we want to share a few practical examples and how you can make use of those practical examples to handle some trades if you see some interesting setup. So one of the things that we have basically shared was that we saw in the past week was that Intel shares. So Intel shares has been on a downtrend for a long period of time, but when we saw what happened this week was that Intel was actually trading near the support level of $29.86. So support level is essentially a price level that shares tend to bounce off when they hit this price level. So they may break through the support level. So meaning to say price may drop below $29.86, but usually they tend to bounce back above this level. And we believe that it could potentially go up to this $31 price level. So our recommendation back early this week was basically to buy call option on Intel at $29 strike price. Okay, and back then the option premium was only $1.67. So if Intel actually rise to $31.38, which was our target, we could stand a chance to make $2.38 per share. So how do I derive this number, right? Basically, I use the target price, $31.38, minus away the $29 strike price. So this is the potential option profit that we could possibly get. And our maximum loss is actually just $1.67. The reason is because, as we mentioned, your maximum loss potential when it comes to buying a call option is limited to the option premium that you pay. Right, so for this trade itself, we saw a risk to reward ratio of 1.4x time. Interestingly, the next day after we published this trading idea, Intel shares actually shot up 50%. Sorry, not Intel share. Intel option for this particular strike price actually shot up 40% on the day itself. So this is an example of how you can actually take advantage of call option buying. Call option buying is actually favorable for stocks that actually you believe will go up and go up quite bullishly. Yeah. The second example that we have was basically this real estate company, this asset management company, Blackstone, with quite a big part of their assets in real estate funds. So what we saw was Blackstone has been trading on an uptrend for a long period of time. But come 2022, Blackstone shares are actually trending downwards. And at the time where we saw the trade set up, Blackstone was trading at $86.40 and having difficulty rising above the $88 price level. So this level is what we call the resistance, which is also the price level that shares typically face a difficulty to break above. Right. So our view back then was that Blackstone shares will find it difficult to go beyond $88 price level. And that it could either trade within this range here, or it could go further downwards. But generally, longer term speaking, we still believe that Blackstone is a good company, right? So if you are a long-term investor, you will not sell Blackstone shares because the market is volatile. So what you could do as a long-term investor is basically sell a call option at the $88 price level, because you believe that you will not go beyond the $88 price level. So why not collect some income in the time being? And the worst case scenario that can happen is that your Blackstone shares are being sold away at $88. Right? That's probably the worst case scenario for you. So back then when we saw this trade, the covered call, the call option for $88 strike price was trading at $3.30 for 1 month, which also represent almost a 45% annualized yield if you were to able to repeat this trade setup for the next few months. So we saw that there was great opportunity to basically profit while the share was trading sideways and also trading on a downtrend. Okay, so I've covered quite a bit on the theory side of things, and also shared a little bit of example. So I think the next thing you may have in your mind is, if this is so good, how can I get started on trading options, and how do I actually go about placing a trade? Right. And this is the next part that I would actually like to share with you to hopefully help you to ease into option trading. So I will just share with you an illustration on how you can do it. So you can click on our app, and you can click on any particular underline you like. In our case, we selected Alphabet. You click on, sorry, this is going a bit too fast. Alphabet, you click on the click on trade. Okay, and and over here you can click on the option tab. Right here, you can basically select the different time period that you are interested in. So let's assume that we are interested in 30th June. You can click on that. And you can select the strike price that you are interested in. So they have a wide range of strike price depending on your view. So in this case, we are clicking into the $124 strike price for the call option. Okay, and based on the last trading price, it was trading at $2.41. Okay, if you look closely right here, we have both the bid and the ask. So the bid price is $2.39. The ask price is $2.46. So what is the difference between bid and ask? So bid price is basically the price that buyers would like to buy the call option at. So buyers are interested to buy call option at $2.39. Whereas ask price is basically the price that sellers are interested to sell a call option. In order for them to have a transaction, the price would usually have to meet somewhere in the middle. So one possible thing that you could possibly do is basically place a price that is somewhere in the middle, or if you really like, you can place a market order. And so if you want to trade on this option, you can click on the trade button. So it will bring you right here. So you can click on the buy or sell. So it will actually bring you to this landing page here where you can actually put a buy order or sell order. Over here, you can select the different type of order. So we have limit order, which is basically trying to place a price that you are interested in. So you could potentially put $2.42 or $2.43, or whatever price that you believe you can actually get the transaction done. right? And if you are happy with whatever that you are looking at right now, you can, okay, so this is actually just the different type of order that we have. So one is the limit order, where you essentially physically key in the price that you like to enter the trade. The second type of order is market order, where you essentially place a trade at the prevailing market price. These are the two big type of order that is usually important for options strategies. So assuming that you want to place at 241, you can just click on buy and confirm. So in this case, your transaction will usually be okay. And if you like to be on the sell side, you can just click on the tab here, sell. Similarly, we have the bid and ask right over here. So you can get a sense of what is the price that this order may actually get filled. And if you're happy, you can basically click on sell as well and click on confirm. And this will basically help you to, and if let's say the transaction go through, you will have successfully sold your call option on this Alphabet shares. Yep, and with that, I think I've come to the end of today's. I've covered most of the content. I would like to actually move on to the Q&A session if you have any questions. Okay, so there are a few questions here. So let me just go through one by one. Okay. Okay, so the first question is, will I get a recording of this webinar? The answer is yes, because we understand that the option content can be you may need to refer to it to basically recap it or refresh our memory. So yes, this will actually be on our YouTube channel, and shortly later I can share the link with you so that you can refer to this again as and when you need it. Okay, the second question is, how do you decide on which underlying stock to trade options on? Okay, I think this is a good question because basically I believe I do agree with you that you need to pick the right underlying stocks to trade your options on, because your option trade is as good as your underlying that you pick. So one of the few things that I look at when I look at underlying stock is, firstly, I want the underlying stock to be a high quality company. And by that, I mean companies with a track record of growing revenue, growing profitability, and companies with a good long-term prospect. So for example, companies like Microsoft that may be actually gaining market share in the cloud computing business, that has a strong market share in the software enterprise business. So these are some of the things that I would essentially look at. Okay. So the next question is, okay, why would you want to sell call option when you are limiting your future upside? Yeah, so as mentioned before, selling a call option may actually limit your future upside. So for example, you buy Coca-Cola shares at 65, you sell a call option at 65, you could potentially be giving up any future gains if Coca-Cola rise above $65, right? But the thing is, while you are giving up future upside, you are also earning option income in the interim period. So the beauty of doing a covered call is that you are getting a stream of consistent cash flow, and you should do a covered call in a sideways market, because anyway your shares are not moving, are having difficulty rising beyond a certain price level, which is your resistance level. And instead of, just seeing your portfolio actually fluctuate for a few months going nowhere, why not just sell some call option, earn some additional income, and you can use that option income to even buy more shares during this period. So this is one of the reasons why I believe you could potentially take advantage of that. Having said that, I do agree with you that, if the share has very big upside potential, please do not sell call option, because basically you will be much better holding on to the share, because your capital gains may be more than how much you are giving up. For example, Tesla, which has gone up almost 50-60% in the past 1 month. If you were to sell call option on Tesla, I believe that you will have done better if you just hold on to Tesla shares. Okay, so there's a question also on, can you sell call without owning the share? Yes, you can actually sell call without owning the shares. In this case, we will call it a naked call position. So what's going to happen is that if you sell call without the shares, and if the shares get caught, so for example, let's say you sell Coca-Cola shares at a $65 strike price, and 1 month later, and you sell it for the end of the month, and end of the month, Coca-Cola share rise to $70, and you do not have the share. What could potentially happen is two scenarios. Number one, you close the option position and you lose $5 per share, because you are obliged to sell Coca-Cola at $65, but now the market price is 70, so you actually have to buy at $70 from the market and sell back at $65. So your option price would usually reflect that already. So you could either close the option position and lose $5 per share, or you could be actually forced to buy Coca-Cola share at the market and sell back to them at 65. So it's possible, but usually I do not recommend that, because that is more risky in a way, because basically it is an uncovered position. Okay, so there's another question, which is, what option should we choose to trade if the share price of a company has hit the resistance? Sell call or buy call, or sell put or buy put? Okay, so the thing is this. So let's try to break it down a little bit, because there are a few pieces right here, right? So if the share price has reached the resistance, what it really means is that the share price has difficulty rising beyond that level, right? So then my question to you would be, are you a long-term investor in this company? So assume that you are a long-term investor. You usually would not want to sell the company just because it hit a resistance level, because usually after the share price hit a resistance level, it will consolidate a while, and if it's a good company, it will further increase in price over the longer term. So if you are a long-term investor, I would recommend you to sell call option because the share would likely move sideways in a short period of time, and why not make some extra income while waiting for the share price to increase? But if your view is that the share price has hit a resistance and you are not particularly optimistic about the long-term outlook for the company, you could also potentially buy a put option to basically protect against a future decline in your share price. So if you ask me, there are two possible things you could do: either sell a call option or buy a put option. But that really depends on your long-term outlook of this company. Okay, so there's a question also on whether I'll be sharing about put option. Yes, so I will actually be sharing about put option in my next webinar. So because there's too much content on this, and I try not to overwhelm you with the content, so I actually split it up into two portions, where I cover call option today. And actually next week, I will be having a session, I think on Thursday. Later, I will flash the timing and the date where I'll actually talk about put option in the next webinar. Okay, so there's a question also on, can you buy and sell option on the same stock at the same time? Yes. Sorry. So for this question, I try to understand. For this, if you want to buy and sell option on the same stock at the same time, are you looking at the same strike price, or are they on a different strike price? If they are on the same strike price, let's say it's the exact option. Let's say you want to trade on Apple option, call option with a strike price of $180 and expire on June, and you want to buy and sell this exact same option, what is going to happen is that the buy and the sell order will actually offset each other, and they will cancel each other out. But if they are of different strike price or different time period, yes, you can do that. We actually have, in fact, this is a more advanced option trading strategies that I also hope to share with you more in the subsequent webinars that we have. So to answer your question, it is possible, but it has to be on a different strike price and or different time period. Okay, so there's also another question on what is the recommended option period? Is it 1 month or how many days? How do you determine it? Okay, so this is an interesting question. So let me think of how can I simplify this for you. So for this question, I will answer it to you this way. It depends on your time horizon. Whether you believe that in the shorter term the share price will move in the direction that you like, or do you think that it will take a longer time for the share to hit a certain price, or do you believe that the window for sideways market is going to be long or short? But one thing I have to caution is that, if you are a option buyer, whether you are a call or a put option buyer, typically a shorter term horizon option, let's say a 5-day, 2-day, or a 1-day option, they typically lose their value much faster than a 30-day option. And this is because of a phenomenon that we call time value of option. This is a little bit complicated already, and actually I plan to cover it in the next webinar. But generally speaking, shorter term options are a little bit more risky, because if you buy a 5-day option versus a 30-day option, on a day-to-day basis, if the option does not move, the option will lose value much quicker compared to the 30-day option. Okay, there's also another question. Can we buy call option with longer tenure with lower strike price and sell call option for shorter tenure with higher strike price for the same stock? Okay, the short answer is yes. There's an option strategy for this, which I plan to cover in a later stage as well, because this is a little bit more advanced. But yes, the short answer is you can do that. Okay. Yeah. I think that is what is expiry date. Okay, I think that's the most of the question that we have today. If there's any that I do not have the chance to answer, or if you have any more questions, I will actually try to answer them as soon as I will try to answer them in the YouTube or over the Telegram. Before this, I would actually like to share with you on our next webinar timing, which is basically on the 15th of June, next Thursday at 7:30 p.m. So I'll be covering on put options as well as some of the option drivers that we talk about, the time value of options, as well as volatility, how volatility affect options, and more importantly, the main thing I want to cover is how put option can play a part in your portfolio and how you can actually also generate income using put option. Yeah. And with that, I have come to the end of my webinar. Thank you so much for being such engaging audience. And I hope you have a great week ahead. Okay. Thank you.